All I can say is wow. The markets are on a tear. We're going to talk about that and what kinds of trades we should be looking for today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic, where we take your questions and take a look at the market. Now, looking at the market, this is quite an interesting one because this chart that I'm about to show you now was making the rounds late last week. And I'm wondering whether it is already, in its own way, it's kind of hard to see it here. I don't know if you can really make this out, but let's discuss what this chart is. This chart is a logarithmic chart for the S&P 500 that goes back a century. And if we sort of connect the tops here and take a look at that trend line, we can see that the S&P is just now reaching, or actually even slightly exceeding, that line for only the third time in 100 years. The two prior instances were the pre-depression peak in 1929 and the pre-tech wreck peak in March of 2000. So, not the most reassuring chart, shall we say. Now, I want to make clear that there are a couple things that I look at this and I want to emphasize that just because you have this trend line does not necessarily mean that valuations are so exorbitant now relative to where they were in 2000, for example. I don't think they are. I want to highlight a couple sort of key differences, regime differences between these different eras. But I also don't want to dismiss the fact that asset prices are starting to get up there. So let's talk about some of these key differences in turn. The first thing that I would point out is that for most of the 1900s, the publicly traded companies in the United States were industrials. These were companies that had significant capital investment, significant plant, and the amount of money that they could make relative to their book value, relative to the investment, could be quite handsome at times. I think we can safely say that Standard Oil was a highly profitable company, but it was very different than the kinds of businesses that we have today, where margins are something that we've never seen before. So that's one sort of principal distinction I would make. Another thing that I've given some thought to as I thought about this chart over the course of the weekend is that the very nature of money itself has changed quite considerably over the last century. If we go back to the 1920s, of course, we were still on the gold standard, and we were on some version of the gold standard up until the early 1970s when Nixon finally sort of eliminated that completely. So I would say that era, so if you can see my chart that I'm showing right here, this period in here up to and about where my cursor is, this is very different. Okay, my cursor cannot be seen, but you can sort of see where the annotation is. So you can't see the cursor, but you can see this little box floating around. So that's really the era that I'm talking about. This is sort of the gold standard era, and full fiat currency is from where this little icon appears right now to the present day. We've had a couple other things that have taken place in the meantime that are even more aggressive variations of monetary debasement, including the heterodox policies that took place following the Great Financial Crisis. That would be Ben Bernanke's money printing in the form of quantitative easing. And then again, we had similar, extremely aggressive monetary policy and intervention, fiscal policy and intervention too, in the post-2020 COVID era. So I'm willing to concede that as we look at this chart, we need to recognize that there's sort of two regimes. There's the, the real money, real currency, gold standard era, and then there's the more recent era of, shall we call it more dovish monetary policy. Combine that with the fact that we have, larger companies than we've ever had before. So, NVIDIA, which just reached fresh all-time highs today. Let's take a look at what NVIDIA's valuation is now, because I didn't even bother to check what it was as of today's close. $4.5 trillion. Near as makes no difference. This is a remarkable number. When you consider that the U.S. GDP in round numbers is about 30 trillion. So the value of NVIDIA. Now, I often hear these types of comparisons made, that people will look at the valuation of something relative to GDP. GDP is the value of all the goods and services that have transacted. So it probably would, in some ways, be more reasonable not to figure out what NVIDIA's market capitalization is relative to GDP, but rather what its revenues are, which is more of a Fortune 500 way of thinking about things when we think about the scale and scope, because after all, the valuation, the market capitalization of a business is not that all of the investors have committed this amount of capital to the business, but rather what the value of those commitments and claims on that business are on the basis of the most recent transactions and what valuation the most recent buyers of those assets are willing to pay. Still, it does indicate just how profound this is. I mean, we take a look at some of these other companies as well. So we'll take a look at Microsoft. Microsoft is now at just under, well, I mean, it's funny. I'm rounding by 200 billion, but that's 3.8 trillion. If we look at Meta, Meta is now at almost 2 trillion. We've got, obviously, Oracle, because they've had a lot of news. We might as well take a look at them. That's a much smaller business, but still, it's obviously been on a huge tear. That one is probably rapidly closing on $1 trillion. I mean, these are all very big numbers, and they represent a disproportionate amount of the profitability of the S&P 500. I guess the thing that I wonder about at this point is, whether at some point there's going to be some measure of blowback about individual companies occupying such dominant roles. And the reason I mention this is I just happened to be, at the same time that I was thinking about this and going back to the early part of the 20th century, back to the early 1900s, I was giving some thought to Roosevelt. Not Franklin Delano Roosevelt, but actually Teddy Roosevelt and the subsequent period of the muckrakers and trust busting. And just wondering whether we could find ourselves at some point in the near future facing a circumstance where, we've obviously seen a lot of populist upswing on arguably both sides of the political aisle, and Alphabet managed to dodge a bullet, not being forced to divest Chrome, but having to open it up to competition. But the truth is, if we think that competition in the economy is simply going to be limited to ensuring that Apple and Alphabet and Meta and NVIDIA and Microsoft and Oracle and Amazon are all able to compete with one another, but almost any other business that would occupy those respective spaces might be crowded out by their dominance and market position, you do wonder whether there's some possibility there. Anyhow, this is just sort of loose talk, things like that. I'm not necessarily suggesting that there is going to be some rash of trust busting or divestment, but I do think it is worth contemplating that, some of these businesses are getting pretty big, and, there are plenty of people running around who aren't necessarily happy about it, other than those who own the shares. So, when I was thinking about those things, I went into the options play application just to see whether I would be able to identify some stocks that would be able to generate an interesting trade without needing to depend on the market continuing to rally from here. So I just went into this ideas tab over here. I'm actually just going to unclick the bullish ones and thought, okay, well, why don't we take a look at, perceived overvalued stocks that have a bearish indicator. And the one that came up over the weekend, appropriately enough, was Toast. So Toast is a software as a service business. It happens to provide services to the restaurant industry. I thought this was kind of an interesting place to play for a couple of reasons, not least of which is the company has recently peaked out over here at just under $50 a share. And that's a high it hasn't enjoyed since late 2021. Now, those who follow the company will probably know that that's shortly after the company IPO'd. Now, at the time that I was looking at this, thinking, oh, maybe this would be one to lean against because it had peaked out in late July, early August, and has since rolled over. The stock was 41 and change on Friday, so it has come in a little bit. But looking at this, I thought, okay, well, let's take a look at a couple things in here and see whether this is one of those names that might be interesting. So a couple things about it. And actually, you know what? I'm going to leave that up for just 1 second because one of the ways we can sort of see what the price of options are is just to take a look at the implied move going out some period of time. So to do that, I'm just going to quickly build an at-the-money straddle. So that's combining the at-the-money call and the at-the-money put. All right, we'll just take a look at a mid-market price. And then the sum of those basically gives you the expected move out to whatever expiration you choose. So 2 months out to November, expected move $69, close to $7, right? And if we go out to December, almost $8, and if we go out to next year, $8.5. I was actually looking at the Januaries when I was looking at this over the weekend, but I actually think that now just looking out to the end of the year might be the most advisable way to think about this on the short side. But just taking a look at those boundaries, assuming that the stock is unlikely to achieve new fresh highs before the end of the year and probably won't violate or test those lows either. So on the upside, it's clear that it struggled at that level and the valuation is a little bit tricky. Now, this is a company that has been growing pretty rapidly, so I'll just show that here. But the expectation is that that growth rate is poised to slow. And I want to also point out that, there were many on the sell side who had actually been expecting that this was going to grow on the top line closer to 30%. And I think we're pretty well disavowed of that notion now. The trailing 12-month growth is now closer to 26%. In the future, it's expected to grow even more slowly. The bottom line, obviously, is growing at a very solid rate. But if we go out to the end of 2027, a time at which the company is expected to make about $1.21 a share adjusted, let's be generous and throw maybe a 40 multiple on the number at that time. Or even 50. Let's just throw a 50 multiplier on that number and just say that, okay, if at 50 times trailing 12-month earnings as of December, assuming that it can hit these benchmarks, that gets us to about $60 a share, and that's $60 a share as of the end of 2027, which is more than 2 years away. So the way I was looking at this, I was kind of thinking, all right, well, this might set up well for a strangle sale. What's a strangle sale? That just means that you sell an upside call, you sell a downside put, you're willing to buy the stock at the short put strike, you're willing to sell the stock at the upside call strike. If you have no stock position, that actually means you would be selling and getting short the stock at that upside call strike. Now, again, the stock was, when I was looking at this over the weekend, the stock was actually higher than it is now. But let's just say I'll take 48, the 48 strike, and let's take Oh, I'll take the 32s or something like that. I'm basically picking options that are worth at least $1. Gets me $2.40. Worst case, I would be long the stock at $29 and change. So that's going to be the 32 put strike that I am short, less the premium I collect. I should probably throw a couple support and resistance lines into this chart so that we can try to get a sense of it here. So you can see that here's the support lines. Here are the resistance lines, so this is consistent with that. Or short the stock at that higher $48 strike, but net of the roughly $2.50 that you're going to be collecting, the actual level at which you'd be getting the short the stock would be over $50 a share, which is higher than the stock has been at any point this year, and in fact at any point since late 2021, and would represent a pretty juicy valuation. So that trade would look a little bit like this. I will say that for those of you who are a little bit concerned either about the possibility of getting short a stock, particularly short a stock that could move 5% in a day as this one has, and that's a legitimate concern, or also are interested in potentially covering the upside because of the capital requirements associated with doing that, one of the things you can do is just convert that upside part of the trade rather than a just outright short call. You can convert that into a short call spread. That makes this into a three-legged trade. That does not necessarily make it more complicated, though. What you're simply doing is buying a cheap upside call just to sort of cover the risk. All right, so here, you would be, purchasing, let's say, a 60 strike call. That thing costs almost nothing. That would mean that the maximum risk one could potentially experience here would be on, no matter how high the stock went, if it got acquired, if it went to infinity, whatever, between now and December expiration, would be about $1,000 per spread, each spread representing 100 shares. Okay, so that I figured would be kind of an interesting talking point. Oh, one other thing that came up that I thought was worthy of mention. Now, I didn't actually see the interview, but I did see that she was giving a press conference. I'm talking now about Caroline Leavitt, the White House press secretary. And one of the things that I saw was said, I did not hear her say it, but I'm taking it on faith from the things I read that she did say it, was that they have gotten $9 trillion in investment. $9 trillion in investment. I'm assuming this was alluding to investment commitments from foreign governments, investment commitments from foreign companies that have taken place since sort of the ongoing tariff hubbub. I could not get to that number in any way, shape, or form, but I did do a little bit of work to say, well, where could that $9 trillion number have possibly come from? Now, it's possible, and please put it into the comments if you know something about this that I don't. If there have been big announcements that have been made that I am unaware of, by all means, please let me know, because I'm legitimately interested. I want to know whether there have been publicly made commitments that I'm unaware of. I will just add, though, that it's hard for me to see any possible way that they could get to the kinds of numbers that we're talking about because of the commitments that have already been made, coming as they have from some of the biggest economies and those most able, essentially, to make them. So what are we looking at here? This is a very difficult spreadsheet to read, so I'm going to have to expand certain sections of it so that you can make it out. But before I do that, let me just describe what this is. Okay, so the top section, that's the section that leads to the number right here that I have outlined, but I'm going to blow that up if I can. Can I? How do I do that? Let's go like this. Whoop. Okay, there. So the number that leads to this right here, just about 3.9 trillion. And normally I like to work in really nice round numbers, but I just put the numbers in that I was able to identify. So what are all of these numbers? What is that 3.8 trillion? That 3.8 trillion represents the commitments that have been made by these countries. Okay? So I'm just downsize this a little bit. But the biggest of these, by far, include the European Union's commitment over an undefined period of time to net investment in the United States of about $600 billion. Japan was amongst the biggest ones. They had two different commitments, which in the aggregate are over $1 trillion. So there was $550 billion in government commitments for U.S. investments in semiconductors, agriculture, and areas like that. And then independent of that, SoftBank also committed, which is in some ways not a huge commitment, because if you think about it, SoftBank principally does invest in the United States anyway. So I don't know that I would think of this necessarily as incremental investment, but collectively that's over $1 trillion. We had Saudi Arabia making a $600 billion commitment. We had the UAE making a $1.4 trillion commitment. And then independently, Demac Properties of UAE had also committed another $20 billion for things like data centers. Taiwan Semi, as probably most are aware, made material commitments. They had already made commitments to start building some manufacturing facilities in the United States, in Arizona, and actually for strategic reasons, I think it makes very good sense for them to do so. Like I said here, MBS, Crown Prince Mohammed bin Salman of Saudi Arabia had made some commitments. In the aggregate, all of the ones that I'm aware of that were published adds up to just shy of $3.9 trillion, and that's a lot less than the $9 trillion I saw reported as having come from the White House press secretary. So where could the difference have come from? Well, I thought, what if they are combining or conflating net investment commitments with tariff revenue assumptions? What then? How much would that add up to? So a number of different sources have done estimates for the amount of money that would be collected from tariffs. And I'm using here a 10-year window. The reason I'm using a 10-year window is because in the case of many of these investments, they also were using a 10-year window. And as it conveniently enough, some of these sources were also doing a 10-year estimate. The most optimistic of these, and I would say that these estimates have since been revised down because the tariff number assumptions probably were more aggressive at the time, was the University of Pennsylvania Wharton budget model assumption. That was $5.2 trillion. The dynamic version of that model is now about $4.5 trillion. So one could say that if there have been other investment commitments coming in from other places, and one could be using one of these more conservative assumptions. But you put those two together, and that gets you to $9 trillion. Here's the problem. There's a big difference to me between net investment and tariff revenue. And the easiest place to see this in the markets is by taking a look at the dollar. If you have a big influx into dollar-denominated assets, into the U.S. market, into U.S. assets, what happens to the dollar? The dollar goes up in value. In fact, this was one of sort of the dollar being the reserve currency's big benefits for the world. That for as long as the dollar was considered to be the reserve currency, that would encourage foreign investment. Money flows in, strengthens the dollar. It does two things. It helps reduce the cost of debt for the U.S. and for Americans more broadly. It increases the value of the dollar, all else equal. It increases the wealth effect, all else equal, thus raising the standard of living for Americans. The thing is that, as I've often said, I kind of believe a little bit in the wisdom of crowds, and the wisdom of crowds would then suggest that if that was what was going on, the value of the dollar would be rising. That means the Dixie Index would be rising, and it hasn't been. In fact, it has fallen. Right? So if we take a look at the beginning of the year through the present, the Dixie Index is down about 11.5%. Okay, I'm done with those things to think about. Now let's get on with your questions. This is a really interesting one. Alex V says, "Hi Mike, what is your opinion on the $100,000 H-1B fee? It looks like Mr. Lutnick is supporting this decision, but I fail to see the benefit to the United States." So one of the interesting things about this is that when I was at Cantor Fitzgerald, as a reminder, that is the firm that is basically owned by the Lutnick family, that is run by Howard Lutnick's two sons, I hired two folks to work for me at that time who were on H-1Bs. And one of them, he worked on the desk with me while I was at Cantor. This was not an unusual circumstance for Cantor Fitzgerald, which I don't know what the number of employees at Cantor is now. It's probably 5,000 or 6,000 when I was there. And this is really common on Wall Street generally, so much so that there are law firms that all of the Wall Street banks use that just handle these kinds of things. It's one of them is Fragman in New York, for what it's worth. One of the partners there actually happened to be a classmate of mine, undergrad. And this is kind of interesting because, it's not just everybody thinks about this as a tech thing, but there's a lot of companies that benefit from getting the brain power that they need into the business. Many times that's going to involve immigrants, and those people are all on H-1Bs. My general view, because I have sort of classical liberal leanings, and when I say classical liberal leanings, I'm referring back to Age of Enlightenment type stuff, era of Voltaire, Locke, and so on, which is going to generally favor more of a free market approach to such matters. If anything, I have felt that the guest worker visa program for the United States actually needed to be made easier, not harder. Now, I actually wasn't thinking so much about the H-1Bs as I was the H-1As. I think that's what the ones that are for agricultural workers are called. I definitely wanted that to be facilitated because the way that process works, you probably would have a lot more legal workers in agriculture than you do now if they would just simplify the process. It's really rather cumbersome. Now, once somebody is on that, they can basically work for 3 years. They can come and go a little bit, and then they have to refresh it. I encourage people to learn a little bit more about that process if it interests them. But there is a material expense, and there is a window of time for the guest workers, which isn't really consistent with the way that agricultural guest workers work. And by the way, I apologize that I'm sort of going off on this little tangent. But my point was that if they facilitated that process and we brought in workers that we need for jobs that we need filled, that we cannot get filled by domestic job seekers or because we don't possess the needed talent in the country, then we want to reduce those frictions. It's better for our economy to have people filling those seats. That is my sense of it. I will also add, though, that from what I can tell, number one, there was a lot of contracting work that was being done. So consulting and contracting firms from everywhere from the Philippines and India and Ukraine, in many cases, were employing professionals on a contract basis to serve some of the roles that are otherwise being met by these. It is a little bit clunky. And I'm wondering now whether, we talked about this a little bit last week, whether AI, which can be a huge productivity enhancement and might be able to fill a lot of roles, is going to help solve a portion of this problem. But yeah, I'm not enamored of adding frictions in general. If somebody could explain to me why this is a really good idea, I'm absolutely willing to listen. One of the things I would say is that many times in circumstances like this, there are nuances in this area, which I wouldn't necessarily be familiar with. I have employed people on H-1Bs myself. I have gone through that process. I did it, ironically enough, when I was working at Cantor Fitzgerald and working for Howard Lutnick. I'm not sure that this is a huge benefit. I mean, obviously the fees would be nice. And if, as some allege, companies are employing people at a discount under H-1Bs versus what they would otherwise pay to U.S. workers, that doesn't seem great. But the other way to think about that is if there are a plethora of talented individuals who have the requisite skill sets, who can fill needed seats, is the world better off because a government elects to impose a material tax to allow them to take those spots? Again, a free market guy, I'm a free market guy, struggles to see how that makes sense. Okay, so Alex V. Oh, same Alex also. Crypto just gapped down. Is it an opportunity to buy IBIT and maybe Ethereum? I'm bullish on these. I have been bullish on these for a couple of years, as most who follow me will know. I think this is more of a technical question, though, and it does seem like we are struggling on the money flow site here. So what I'm just going to do is allow the technicals to speak for themselves, and folks are free to make their own judgments. I believe that the fundamental case remains. It appears that most of the best technical indicators for Bitcoin, at least, remain positive. And we'll do the same thing here for, I'm just going to use this one. Why not? Do we want to use the Grayscale Ethereum Trust? Here we are. Put that in. So these are the best performing ones here. In general, most are bullish as well. Ichimoku, which this one is not. Let's just take a look at how that charts out. I don't typically use this as a technical indicator. I am a simple guy. I like simple lines typically, but I'm always curious to see how some of these strategies have timed their trade. So this one got long back here on July 10th. So it's not like this thing is day trading it. So it closed and went short right here, which I guess is a little bit supportive of how somebody who would draw the lines fairly simply might look at these things, which is to say, we were certainly definitively in an uptrend here, and maybe now we're beginning to test it. We're bouncing right here along the 50. If it breaks that, that's not necessarily a positive. If your view is long term, fundamentally I still like these. But I think, on a technical basis right now, the story's a little bit more mixed. Okay. Finwest, good morning, Mike. Good morning, sir. Hope you are well. Thanks for joining us again. Tucker D. Dog says, S&P 500 looking like U.S. wealth distribution with top 10% concentrating the majority. I'm assuming that Tucker D. Dog is talking, in this case, about the relative concentration in just a relative handful of the S&P 500 constituent stocks. So maybe much like the economy itself. Okay, if people keep buying calls, shorting puts, and market makers have to hedge by buying stock, is there a way to know when the opposite will happen? So, let's just take a look at this in two parts. First of all, is it true that if folks are buying calls and selling puts, that the market making community is buying stocks to hedge the delta of taking the other side of the trade? And the answer to that is yes. Market makers hedge their deltas. So if they are selling calls, they buy stock to hedge. If they are buying puts, they buy stock to hedge. So that part is 100% correct. The next question, though, is that what market participants are doing? Some of them certainly are. But I think it's worth noting that there are plenty of players out there who are buying stocks and selling upside call options. That, after all, is sort of the principal strategy at YieldMax. So, some of you may know, others may not, but, worth a mention. I am the YieldMax strategist. So within YieldMax, there's probably about, 19 billion or so of strategies of that type within the umbrella of the parent company. Not all of them are options related strategies, but maybe there's another 7, 8, let's call it 10 billion in similar strategies outside of YieldMax. So that's 30 billion. It's a lot of options being traded and a lot of calls being sold. Without getting into too many particulars, I think we traded, call it 9 million contracts or so last week. So that's quite a lot, especially when you consider that most of that is in the single stock space. We do have zero DTE stuff, so that's not to say that we're not also trading, things like SPX, zero DTE. But, the bulk of that is going to be in single stock options. And when you consider that, what's the average volume on a given day? 50 million contracts, half of that is probably zero DTE stuff. So that's 25 million contracts. You're looking at 125 million contracts a day. So if one outfit, ours, is trading 9 million contracts out of that volume, or about 7% of all the U.S. options volume, and most of that is on the short side. If the next 9 million was all buying, then that's a push, right? That's now we're up to close to 15% of the U.S. options volume. So is all of that call volume being bought? I don't think it is. I think there's kind of a mix. I would say that most self-directed investors who are first getting started with options, on balance, are probably long premium. That is to say that they're looking for defined risk, high leverage. And I'm not saying that's an intelligent way to trade, but I'm just saying that from what I've seen, anecdotally, people who first start trading options often do that. They start buying options to make directional bets. That's a low probability and low success rate type of a trade. I don't necessarily encourage it, but I'm just saying that's what people do. So there is a lot of that going on, but it's not the only thing that's going on. So I guess this is a long-winded way of saying we don't want to make the assumption that all of the call volume is therefore long. Okay, so now we have now gotten through two steps of all of this, which is that, yes, the market makers hedge, but not all of the market participants are buying calls. I don't have a good sense of what the balance is, but let's just assume it's 20% for sake of argument. 20% net long, that the initiating customer side is 20% net long, upside calls. No basis for making that, but what would that mean? So then you would take the total open interest and say, okay, what's the gamma exposure of all of that? And if that therefore reversed, what would happen? So if market makers are short calls and long puts, the good news for the market in that situation would be, assuming options flows don't change very much, that market makers are net long downside gamma. Okay, what does that mean? That in that framework, in that construction, the assumption then would be that the market making community has stock to buy as stock prices decline. And that has a net stabilizing effect on equity prices if that's true. So from a long equity market participant's point of view, you kind of hope that's the case, because that would be stabilizing to prices. But I will also say that when markets begin to crack, a lot of things start happening, and a lot of them start happening at the same time and quite quickly. And so that is one of the reasons why the overarching assumption that many options models make, which is that prices are continuous, that is to say that they don't experience jumps, is a little bit flawed, because that there's an old saw, the markets take the stairs up and the elevator down. And I think there is some truth to that, and I have no reason to believe that the current market is going to exhibit a dynamic any different than it has for a century. Okay. So let's see here. Monday morning quarterback. Toast is a Josh Brown favorite. Lots of competition from Block and Clover. It's interesting. I saw a video with Josh Brown. I think it was from Friday, and he was on actually with and I'm not friends with Josh, but we are certainly acquainted. He used to do Fast Money from time to time, and I've seen him around here and there, not in recent years. I have a lot of respect for what Josh and Barry and the gang over there have done, and for the following that he has built. I will say he did a video last Friday. They actually mentioned some options-based ETFs, and they got a number of things quite wrong. I don't think Josh actually got anything wrong. He was just reading an article, but Tom Sosnoff, who I'm also acquainted with, started to talk about these things, and clearly he's missing a bit of the plot. Again, I don't think it was malicious. I mean, these are not malicious people. They're actually successful and thoughtful people, but sometimes people will be happy to opine on things where they really don't know what's going on under the hood, and there was some evidence of that. My thinking on Toast, I am sure, first of all, Josh tends, on behalf of his clients, I know, to have a very long-term perspective. Options trades, by their very nature, tend not to be that long. This one is not. The one I just proposed only runs out to December, so we're looking at something that goes just under 3 months, I think, until December expiration. What I'm suggesting doesn't have to be wholly incompatible with that. What I'm just suggesting, though, with respect to Toast, is that I don't think it's likely to hit fresh new highs this year. I may be off, but that's my suspicion, is that it does not. Even to hit the highs that it has already approached in late July and early August, the stock's going to have to go up more than 25% in 3 months. And, the valuation is it totally crazy? Well, it depends a little bit what your long-term assumptions are, right? I illustrated that there is a way to see how the stock gets to 55.60 by end of 2027, assuming that their revenue and adjusted EPS growth trajectories adhere to, the consensus expectations for that. Understanding at the same time that they occupy a technology space that has seen some competition, as you guys rightly point out, and we have a lot of new technology coming down the pike, and we have American consumers who are arguably a little bit stretched. And if they are, then that's going to hurt restaurants' ability to make these kinds of investments. So you put all that stuff together, and that's how I came up with my thesis. And Josh may indeed be right. Maybe it is a $60 stock by the end of 2027. I'm not betting for or against that. I have entertained the possibility that it is. Certainly, there's a way to get there. But what I'm saying is that I just think that it's more likely the stock is range-bound in the short term. It's not Josh. Joseph, I had Josh on the brain because of Josh Brown. Joseph came in. Hi, Mike. Is Fluor better AI play than SMR itself, as it owns many A and B shares of SMR? So this is a topic I've brought up, I think, on at least 2 or 3 occasions. I do prefer Fluor. So for those who don't know, SMR is this small modular reactor startup company. And Fluor is, an engineering, construction, and procurement business that owns a big chunk of it. So let's take a look at the two. So I actually thought that this was going to be a a real area of potential growth, was this small modular reactor type business. And if you look at uranium prices, that suggests that a lot of other people believe this. There's large data demands. It's probably viewed to be more environmentally friendly. One would hope that they can find a way to get the construction costs such that these things become economic. Fluor has considerable experience in the construction, maintenance, and decommissioning and recommissioning of nuclear power plants. And they own a big piece of NuScale. And on top of all of that, when I mentioned this before, the company was trading, pretty cheaply. So I think we got into this. I mean, we can probably look up when that video was. But if I remember correctly, we were talking about this thing trading in the low teens on a forward basis. And we're a little higher than that now. Part of that could be because EPS assumptions have dropped a little bit. But, 234 on a 14% growth rate. Top line a little bit laggy relative to, what I like to see. As I previously pointed out, when you start looking at individual companies, what you're hoping for is that they exhibit some exceptionalism relative to the broad market, because that's the alternative. You could just buy the S&P and set it and forget it and just make regular investments, and you can probably expect the top line of your net investment to grow at 4 to 6%, and the bottom line to grow, at 7, and actually recently to 8 compound annual growth rate for S&P earnings has been about 8%. Important to note that a lot of that is coming from the best performers, as Tucker D. Dog previously pointed out. There's some buyback, so there's the accretive effect of buybacks. It's one of the reasons I like to look at net income growth as well as adjusted EPS growth, so that I can say, okay, well, how much of this is organic business growth and how much of the EPS growth is really, net of the accretive effects of the buybacks. But, here we have, so the actual estimated growth, we'll just call it 390 over 344. So we're looking at 13% anticipated net income growth year on year between the end of this calendar year and next. And, the business is, as we're currently seeing it, it's trading at, that number. Oh, actually, there's another quicker way for me to do this, but that's 19 times forward, with an anticipated free cash flow yield of 7%. So, yeah, I kind of like the Fluor way to play this. Something else to think about. It's not like Fluor is a $1 trillion business, so that if NuScale suddenly turns into a huge business, you won't capitalize. You will capitalize, right? Because this is actually only a $6 billion enterprise value. So my 2 cents, I kind of like Fluor as the means to play it. Hope that helps. So don't confuse H-1B employees as a source of brains, but instead cheap. I work in pharma, and they have outsourced to the cheapest at any cost, which is typically India, and the quality is poor. Okay, well, I guess that was your experience. I will tell you that the guy that I had working for me, he was from India, and he was brilliant and hardworking. I mean, really, really phenomenal. And I recommended him very highly when he went on to other work. And the way I described it, one of the most astonishing things that this guy did is, I remember shortly after he was working on the desk, he was doing a lot of program and development work on the trading side. And I happened to be talking to one of the traders that worked for me, who was just off my right shoulder. Akil was around the corner. And I was saying, if only we were able to have a system that did X, Y, and Z. And I just had a couple sort of feature ideas that I really thought would be appealing. And the next day, and I got into the office pretty early in those days. Phil Marber, who was the president of Cantor Fitzgerald, he might have been one of the few people in that room that would get in earlier than I would. There were days when I rolled in at 6 in the morning, and he was there, and he looked like he'd already been there a while. I came in the next morning, and Akil rolled in 7:30 or whatever. And he said, yesterday I overheard you saying that, if you had a feature that did X, Y, and Z. And he said, is this kind of what you were thinking about? And he had something up. He had coded something overnight, and it worked. It was basically exactly what I had been thinking. And I hadn't even spec'd it. It was just something that I was thinking about and talking to another trader. He overheard and was just thinking, what value can I add? And he had done it. Everybody's experience is going to be a little bit different on this side. I will tell you that in our business at that time, we had no interest whatsoever in trying to save money. That was not the idea. They were talking, when I was there, they were talking about hiring a guy away from Jeffries, and they were offering him something like $25 or $30 million a year guaranteed to come over. He never did, but for the right guy, they were prepared to pay a lot of money. A couple $100,000 this way or that was not going to make a big difference to them at that time. Now, the market and the business has changed markedly since then. In fact, it actually did change almost immediately in the years that followed. The business just became a lot less profitable for a lot of reasons. But yeah, my experience with H-1Bs is quite different than yours. Alex V, well, is it true that Indian and Canadian applicants are getting 90% of H-1Bs? Oh, China. No, CN, that's China, sorry. I don't know. I don't, all of you watching probably have a better sense of this than I do. So I can't opine intelligently on that. I don't have any data. Okay. A higher fee just means people that sponsored will now just fully outsource. The modern era of remote work just makes it easier. A bit surprises many still sponsor H-1Bs now, as remote work is so easy. Yeah, it's a good point. What I always worry about with those outsourced contracts, how much of the hours of a day are actually spent by them working for you, rather than 2 or 3 other companies that maybe they also signed contracts with. I kind of feel like, and I haven't really dealt with that as much personally, but I always just have that sense that that outsourcing, they're just like, oh yeah, well we're a dedicated resource just for you, and then they hang up the phone, and the next thing you know, they're a dedicated resource just for some other guy, and then they're splitting up their 12-hour workdays into 4-hour shifts for 3 different companies. Who knows? I'm just speculating. I have no idea about that, but that's what it feels like. Hello, Mike. What do you think about Intel with the U.S. government taking a stake in NVIDIA investing? Would it be good going forward? Do you think is good going long on Intel? So this is an interesting one. The deal that they did with NVIDIA, by one thing I read, is 2 to 3% on the Intel revenue line. And somebody was just making the comment that they just thought that the total addressable market for that area of their business was relatively small. And I'll go along with that. In fact, I think it was Citi. In fact, if you guys bear with me, I'll find out exactly who was making that comment. I read, right after he published it, I read the research report, and I'm 90% sure it was Citi. Let me double check who it was and what they said, because this may be helpful. Here, is this it? Yeah. Okay. Oh, how about that? Okay, so we found it. Yeah, this was the one that was sent to me. So they downgraded it to sell from neutral, and this was essentially their thesis over here, that NVIDIA was throwing them a $5 billion life preserver. The stock was already up about 50% after this. And here it is, the section I was just talking about. The custom CPUs for NVIDIA is a small total addressable market. What did I say? 2 to 3% of their total sales? 3%. Okay, there's the number. That's looking at their 2026 numbers. I'm not quite as pessimistic. Here's my rationale. The reason I am somewhat less pessimistic than the Citi analyst is, number one, Intel's fairly well positioned, shall we say, from a political standpoint now. But actually what that ignores is, sort of the virtuous cycle. In other words, you're trying to get a good job, but it doesn't come up. But the company that you want to work for is willing to employ you in some other role. Should you take that role? And is there anything good that's going to come out of it? Well, my guess is that once your foot is in the door, it could lead to other bigger and better things. So I don't think that it's appropriate to take a look at the custom CPU business in that transaction or the proposed deal, I should say, between NVIDIA and Intel should simply be siloed into a 3% of 2026 revenues type of number. Not to mention the fact that incremental top-line benefits for companies that are kind of floundering carry huge benefits, right? So if we take a look at it, 3% of total revenue for Intel full year 2026 is about $1.5 billion. What's the margin on that $1.5 billion? So the whole company is expected to have net income of about $3.1 billion for the year, which, by the way, if these numbers are accurate, it's not like the company is overwhelmingly cheap. The thing we want to see is we need this stuff that's going on down here at the bottom. I'm highlighting this line. You might be able to make it out. Negative free cash flow, negative earnings. They need to stabilize that. And this certainly could do all of those things. But I will just point out that the company's not terribly cheap. But I do also believe that this deal is better for the business than just that top line would suggest. And it kind of signals that private industry is kind of going along with the government's support of the company. So I don't know how helpful that is. I'm not overwhelmingly bullish on Intel, but I do think that even as small as that deal is on a relative basis, it gives them more runway. And I don't know how much that helps you. J-Bow, Micron reports tomorrow evening. I have a 170, 80, 2.5, 90 broken wing call fly. The break even is 172. If the stock rallies during tomorrow's session, should I close it early? Early. You didn't provide the expiration. I'm assuming you mean end of week, Jay. So you can clarify. Oh. Yeah, okay, week ending. So and also I guess my next question was, do I think it's advisable to close it early, as in before the number comes out or after? That depends on what the stock does. Stock runs. If the stock runs to 182, I will put it to you this way: if the stock ran to 182 at any point tomorrow, which would be a big run, the stock was only up $1.89, and that's we're talking about a rally of in the teens dollars wise. That would be a huge move. Then I would take it. I don't think you're going to get that shot. But my inclination is that, I would probably take the money and run. If it ran up to my short strike with a week-ending fly, Because what are you waiting for at that point? Your hope then is that the stock does not move materially between then and the end of the week. How much of a move is that? Well, that's going to be $7.50 on a nearly $200 stock. So you're looking at 3.5–4% of the current stock price for something that would have had such a pronounced move in just the last couple of weeks, and then will have had another pronounced move on the back of earnings. You know, if, and a lot of big moves. So the short version is, oh yeah, you're saying before the number is out. Yeah, so it's, I mean, one of the things I say about flies is that you are really trying to thread the needle. I'm not saying you should never do them. I actually talked about them in Netflix. Viewers will remember right before they reported ahead of Good Friday on this channel. Sometimes I think they can be very interesting in those types of setups when you can really use them kind of like a binary option. And that was, you know, so basically it wasn't even a one-day trade. It was an hour-and-a-half long trade. Basically, you could put those things on for next to nothing and then trade it between then and the last minute before. It wasn't even an hour and a half before you could put in your exercise or contrary exercise notices, and that was really the play. The issue with trading flies on a longer term basis is that you are not only choosing whether a stock is going to go higher or lower, you're choosing a price and you're choosing a time. That's a lot of things to get right. It's challenging to get that right. If I was in that trade and it was profitable, yeah, I probably would, because if things are working your way, the chances that they're going to keep working your way, that the price is actually going to get to what you want and then stay put through the end of the week, and something that's been moving this much, it doesn't seem that likely to me. The downside of that, though, is that when vertical spreads really pay off is when they expire, or if volatility gets crushed, because that volatility crush has an impact on options prices that is very similar to the passage of time. So if you take a look at any option and you dial up the implied volatility and you extend how much time to expiration, the impact of those two things on an option's value is going to be very similar, and for a good and intuitive reason. What can happen over a certain period of time if the volatility is low, or what can happen over a smaller period of time if the volatility is high? Really, you're just talking about how much the price of the underlying asset can move relative to the strikes given the volatility and the time assumption. So the vol crush, if you get onto the right price, you know, I will say this, if you held it, this is just a general thing, not about this, but if you have a vertical spread and you play for a catalyst, and after that catalyst comes and goes, it basically kind of goes to your number, and you're saying, do I now rest for the balance of what's in this trade? The answer is generally going to be no, because the combination of the fact that the stock went your way and you got the vol crush, you know, that's pretty good. You got two things working for you. Don't get greedy. That would be, you know, my two cents. DJ, we keep hearing energy is important for AI, and we need every bit of it we can get. So why isn't NEE getting some love? Well, Next Era, first of all, is this how? I mean, look at what has happened to some of these companies. You know, let's take a look at the valuation for this puppy. I mean, a lot of these companies have done very, very well. And there is one issue, and that is how much exposure does any one of these companies have to it? What's the one I'm drawing a blank. Someone can help me out here. That, you know, it's basically it was the data center energy play last year and probably the year prior. It'll come to me in a second. The thing is that these guys do occupy a regulated space. So when you look at one of these businesses and say, okay, how good is the potential, you have to take a look at what you think their growth trajectory might be. Next Era, $4, $4 a share is what they're expected to do 2026. Round numbers. Actually, it seems quite reasonably priced. But this is not the growth story. Maybe somebody on the production side can look it up for me. I'm just drawing a blank. It's gonna, and when the minute I hear it, I know it's gonna really tick me off that I couldn't come up with the name. Let's see here. What we got? A couple names are being thrown out here. Vistra. That's what it was. Vistra Energy, of course. Yeah, that was the big play. I knew it was going to just drive me bonkers as soon as I saw it. But actually, not for nothing, if one feels like the market's a little bit extended, not a terrible place. Not a terrible place to be. If you think that rates are going to come in, and the market's forecast for rates is that they're going to be cut more aggressively than the median of the FOMC committee members themselves have suggested by year's end. I think it's 50 basis points in the Fed Fund futures that are implied into the cuts by the end of December, that the median of the committee members differential expresses. So I think that's kind of interesting. So not the first company that would have come to mind, but I think NextEra is okay. Boo to you. Hi, Mike. Gold, silver outlook. Don't stop until it stops. Although I still think there might be room in the miners because they underperformed for so long that I think this is probably, there's still some room as big as this move has been. People have often said that the miners would basically be a 2x play versus gold, and that was not true for a while. And if we take a look, so what has, I think that both of these are probably decent places to remain. You can't really give up on this trade until it gives up on you. I'm not going to try to call the top here. And by the way, we were looking earlier at the Dixie, right? And not for nothing, who amongst the big institutional buyers of gold are about to turn seller? China? Any other central bank? Countries continue to repatriate. They're net buyers. Saudi Arabia, which used to be almost a gold speculator relative to crude. Crude prices aren't doing that great, and yet they continue to accumulate, or at the very least hold on to their gold reserves, whereas they used to sort of trade in and out of it. Someone's going to have to turn seller in gold, someone big, before I'm going to turn bearish on this thing, and you're going to need to see a reversal. Things to keep an eye out for, though. Here we are again at fresh all-time highs. The thing that I would always keep an eye out for in any commodity is that big downside reversal. What's the downside reversal? The day you wake up, it gaps to fresh highs, and then closes materially lower than the day prior. That's a very unhealthy technical pattern. Rising. Rising was my acronym on the channel here. It had two G's, though, Tuckerty Dog. It was RISINGG, R for RSP, I for IBIT, S for SCHH, N for Nance, NANC, G for GOOGL, as in Google or Alphabet, and the other G for GLD as another proxy for gold. The Rising acronym is outperforming the S&P, which isn't half bad on a year where the S&P is up. So Tuckerty Dog, there were two G's in the open mic Rising acronym. There was only one on the CNBC one, and that's because they clipped it and said you can only have 6 letters. Actually, my first acronym for them was much longer. It was Bond Vigilantes. And I can tell you, had I done that thing, it would have crushed it. I gave them all the tickers for Bond Vigilantes, which I also thought was rather clever because it sort of adhered to my sort of monetary debasement and net effect on, well, treasury bonds and other things like that. But anyway, the winner for the people that are in the lead right now for the acronym challenge on CNBC, they are gapping me right now. So the best performing ones this year are, and I'm going by memory, but Steve Grasso is right up there. He might be number 2. I think the last time I looked, his acronym was up around 32, 33%. I have a spreadsheet actually that I run that keeps track of all of those things. I think Guy Adami was in first at like 34% total returns year to date, and Karen Feinerman and Bonawyn Eisen were literally breathing down Steve's neck. Also, both up more than 30% year to date. And then I think, I was basically in 5th place behind them. And then I'm not going to bother to mention the people that, are dragging up the rear, but they can all, people can go back and check the records for themselves, and I'll update it before I do the next one. The thing that impresses me, though, in this list is not that, Guy Adami's in first place, or that Karen, who I really like her investment philosophy. She's kind of a deep dive fundamental investor, so I like that as an approach. But the thing that's impressive to me is Steve, because Steve is second this year. He was second all year last year. And I hammered the S&P 500, and he and I were within like 1% of each other. It was neck and neck all the way to the end of the year. So his performance is particularly impressive when you consider that it's impressive this year. He crushed it last year too. I don't remember what his performance was the year before, but that's saying something. It's always very nice when you can generate outperformance, but what really matters is outperformance year after year after year. And so, to his credit, I'm not, what am I going to pat myself on the back because I picked 6 or 7 tickers and it's outperforming the S&P by 150 basis points or something? I shouldn't be getting medals for that. That's nice, but it's not. No one's going to win awards. But I will tell you that Steve Grasso's performance has been good for a couple of years, and he's locked some of that in because one of his picks for this year was U.S. Steel, and they got acquired. So that money's in the bank. Anyway, what is Carter saying about gold? Alex V asks. I will take a look and see whether he sent me any recent emails about it. He was bullish on gold, I know that. I'm assuming he still is. I'm going to just double check though. Oh, that's my own article where I said gold still. So I only just, when did I put that out? Oh, on September 11th. That's probably why I don't remember it, because that was a really strange week. That was when Charlie Kirk got murdered. Yeah, on the 11th I published an article that said gold still glitters. So I thought that was his. Let's take a look. Gold mine. Okay, so we think it is right to reverse, and the February to be long. Oh, okay. So this is interesting. Very recently, Carter was saying he was bullish on both, but he was more bullish on the miners, and he very recently said that now he thinks it's better to be long bullion versus the miners. All right. So that is so he is bullish on both, but he was more bullish on miners up until a couple weeks ago, and he reversed that position. That doesn't mean he's bearish on the miners. It just means he's more bullish on the bullion than the miners. Okay, so that is that. Now I have chewed up an hour and 15 minutes, so we're running out the clock. PC says Elon Musk said that he was H-1B. H-1B, he must have been here on a student visa at first when he was at Penn, I assume. So he did his undergrad in physics at Penn and then was going to get his PhD at Stanford, if my memory serves me correctly, and then he bounced from that to doing some startup-related stuff. I think I answered most of the questions here. Oh, DJ, you said, how about Duke then? Same thing. I actually think, look, if the market starts to get chopped up, don't forget that the utilities tend to be considered safe haven. So what do we have here? 671 full year. So that works out to it's the same multiple as NextEra, 18 times forward. Negative free cash flow, not great. There's a lot of capex needed. Fair enough. But yeah, I think so. Duke Energy. I think I answered most of the questions. I probably skipped a page. I really do appreciate you guys tuning in and listening to me ramble on all sorts of topics, and we seem to have hit things that are relatively far afield of one another today. Everything from H-1Bs to whatever it was that White House Press Secretary Caroline Leavitt was talking about with that $9 trillion investment number. I don't know. Was that tariff revenue plus net investment commitments? It doesn't add up. It doesn't add up to me, and I would just go a little bit further by saying that you will know that the net investment commitments are meaningful when the dollar stabilizes. Right? That's the real tip-off as far as I'm concerned. So like, subscribe. If you have further questions, put them into the comment section. If you don't feel like doing any of that, then just come back on Wednesday, and we'll see you then, 4:15 Eastern. Thanks for watching.